In this final module on costs and cost behavior, we are going to look at the cost volume profit model as it relates to a company that sells more than one product or provides more than one service. So we introduce now the weighted average contribution margin, and we use that to calculate break even and target net income. The lecture concludes with a discussion on operating structure. This is the final model with cost volume profit analysis. Now, today we've been looking at cost behavior, and we developed the cost volume profit model, which we use to predict zero profit and then target net income. We did all that with the understanding that the company we're doing it for sells a single product or a single service, provides a single service. And that's not the case for many companies. So now we're looking at how we use the cost volume profit analysis for a multi-product company. And that is a company that sells more than one product. And therefore, what we have to do is bring in the idea of sales mix and look at how the sales mix will affect the break-even sales. So we introduce a new concept called the weighted average contribution margin. And with that, we are then able to determine the break-even sales for a multi-product company and target net income for a multi-product company. Now, also in this module, second part in another video will be the idea of using operating leverage. And so therefore we want to understand how operating leverage affects profitability. And that will be in the second video of this module. Now to begin with, break even sales in units when I have sales mix is the sales mix itself is a relative percentage in which a company sells its product. Now, over time, a company that sells more than one product begins to realize that there is a mix, that for every one of these, they sell 3 of these, or every one of these, they sell 4, or every 2 of these, they sell 3. So the sales mix, for example, if a company's unit sales are 80% printers, and 20% computers, then we say its sales mix is 80-20. And this sales mix is very important because the products we're talking about, printers and computers, both have different contribution margin. So companies can compute the break-even for a mix of 2 or more products by determining the weighted average unit contribution margin of all products. So let's go through an example. Vargo Video sells not only camcorders, but TV sets as well. Vargo sells its 2 products in the following amount: 1,500 camcorders and 500 TVs. So the sales mix can be expressed as 3-to-1 or 75%, 25%. That is, the total amount of units that are sold are 2,000. 75% of those 2,000 are camcorders, whereas 25% are televisions. So therefore, what we have to do now is determine the weighted average cost of capital. So we have this information with regards to Vargo. We know the sales mix is 75-25. We know the selling price of camcorder is $500, the variable cost is $3, and the contribution margin is $2. Televisions has a selling price of $1,000, variable cost of $500, and a contribution margin for each unit of $500. Now that's the variable cost we've covered. Now the fixed costs, you see, are common to both. Fixed costs are cost of capacity. That is the rent and the electricity and utilities. All of that support both products. So the fixed cost can't be divided between camcorders and television. They support both. So what we do then is we take the sales mix and the contribution margin for each unit, and we develop a weighted average contribution margin per unit. And how we do that, take the camcorders, the unit contribution margin is 200. The sales mix is 75%. So I multiply that by the 75%. The television has a unit contribution margin of 500, and I multiply that by 25%, add it together, and I get a weighted average unit contribution margin of 275. Now that's not the camcorder, that's not the television, that is both of them weighted by the sales mix. So now, if I want to determine the break-even in units, which I do here because I'm using the unit contribution margin, I simply take the fixed cost, divide by the contribution margin per unit, weighted average contribution margin per unit, and I get 1,000 units. Now that's 1,000 camcorders and televisions. But I know that I sell the units, 75% of units I sell are camcorders, 25 are televisions. So I work backwards and I say, okay, the break-even sales in units will be 750 camcorders and 250 televisions. Now to prove that out, if I sell that, you can see unit sales 750 for the camcorders times 200 is 150,000 in total contribution margin from the camcorders. For the televisions, unit 250 televisions at 500 unit contribution is 125,000, and there I have total contribution margin on 1,000 units of 275,000, which is my fixed cost. Therefore, that is my break-even in sales. Now, most often, though, in many companies have more than two products. You can think of a grocery store or a clothing store, what have you. There are many, many products in those companies. So it's more useful now to use the contribution, weighted average contribution ratio, okay? Because that works better if we have a company that has many products. Now we can look at breaking up that company into divisions, or we can look at it in product lines. But we're not looking at it in sales dollars. It's too difficult to come up with a contribution margin for each product individually. So we do it by divisions. So let's take a company here that has two divisions, a garden supply company. And the information is such: we have indoor plant division and outdoor plant. Now the total sales are $1 million. And that is broken out into 200,000 indoor, 800,000 outdoor. Now the variable costs for the plants that we sell outdoor are 120, so the contribution margin is 80,000 on the total sales. The outdoor variable costs are 560, so their contribution margin is 240. Now you can see right off, if I have $1 million in sales and 200 are indoor and 800 are outdoor, then I would say, okay, the sales mix then would be 200 divided by $1 million, or 20%. And the outdoor would be 800 divided by $1 million, or 80%. Now I have to take the contribution margin and turn it into the ratio. So I get the contribution margin ratio for the indoor plant division. That is 80 divided by 200,000, or 40%. Now for the outdoor, it's 240 divided by 800,000, or 30%. So weighted average and weighted together, they're 32. Now the fixed costs, as I said before, are common to both. So the fixed costs here are 300,000. So first we determine the weighted average contribution margin ratio. And we do that by taking the contribution margin ratio of indoor times the sales mix plus outdoor times the sales mix. And I get a weighted average contribution margin ratio of 32%. So I divide that into the fixed costs, and I get break-even point in dollars, $937,500. All right, so that's a combination of both indoor and outdoor. So then again, the sales mix for the indoor and outdoor was 20% for the indoor, so 20% of 937,500 would be the break even for the indoor division. 80% times 937,500 or 750 would be the break even for the outdoor division. Okay. So you can see, and a company knows this, they want to influence that sales mix by selling more of the higher contribution product. So if the sales mix becomes 50-50, if you did the calculations, the contribution margin ratio would change to 35% and the break-even would be lower. So that's how we use it in terms of multi-product company. So here's a question. What do you think? Net income will be A, greater if more higher contribution margin units are sold than lower contribution margin units. Greater if more lower contribution margin are sold than higher contribution. No. Equal. No. Undecided. No. The answer, of course, is A. And so for sales, that sales mix with the different contribution margin is very important. A company will try and push the products they sell that have the higher contribution. When you go in and buy your groceries, you'll notice that at the front of the store are DVD discs or confectionery gum or soft drinks. All of those have very high contribution margin. Not only that, the way companies stack their shelves, the products with the higher contribution margin are usually at eye level, and the ones that are lower contribution margin to the company are the low level. I'm not talking high price, low price. I'm talking about how a management in a retail store organizes its products so that it's pushing the higher contribution margin products to the customer, because the more the higher contribution margin products they can sell, the higher the profit, because the fixed costs are the same. Now, sales mix and contribution margin analysis is very important in the production area, especially because we are always working in business with limited resources. Limited resources such as space or raw material or labor. And therefore, management must decide which products to sell to maximize net income. So here we have Vargo again. They make the camcorder and the television. However, the machine capacity they have to make both of them is limited to 3,600 hours per month. So now we look at the camcorders and we say, okay, the contribution margin for every camcorder that we produce and sell is 200. For television, it's 500. However, the time it takes to manufacture on that machine, because I have limited capacity on that machine, is 0.2 of an hour, whereas television is 0.625 of an hour. So you see, the machine capacity is the constraint. And anytime you have a constraint, you look to maximize the contribution margin per the constraint. In this case, the constraint is limited resources. So back to our example. Contribution margin per unit, camcorders 200. However, if I look at the contribution margin per unit for camcorders per the constraint, that is an hour, I can produce 5 camcorders in an hour because it takes only 0.2 of an hour to do it. So the total contribution margin in 1 hour for camcorders is 1,000. For televisions, I can only produce or get a contribution margin of 800 by multiplying the 500 times the 0.6 of an hour. So I can only do about 1.5 televisions. So you can see there that management, if they have a choice, would produce, if they could sell it, the camcorder. Because if the demand exists, then you maximize the contribution margin per the limited resource or per the constraint. So if Margot is able to increase machine capacity to 3,600, now I'm talking about more machine hours and getting an additional 600, that could be used to produce either camcorders or televisions. Well, again, you can see that the camcorders, that extra 600 hours, when I have a contribution margin per hour of 1,000 for camcorders, is 600,000, whereas for televisions, it's 400. So you see, when we have a constraint like limited resources, then what we do is we attempt as management to maximize the total contribution per the constraint. Okay? And that concludes, except for the second part of this module, which is a degree of operating leverage. But this is a summary of the cost, volume, profit. This is a review starting back 2 modules. We began the basic concepts. First of all was the cost, volume, profit income statement. Once we were able to determine which expenses were fixed and which expenses were variable, then we were able to produce what's called a cost, volume, profit income statement. Now this information is only for management. And we put it in a special format. And we introduced the idea of a contribution margin. And we do that in total, and then we do it on a unit basis. And we do it as a ratio as well. So now, we then put that together to determine a break-even at 0 profit when the total contribution margin equals fixed cost. Now, if I want break-even in units, I divide the fixed cost by the contribution margin per unit. If I want to break even in sales dollars, I divide the fixed cost by the contribution margin ratio. If I need the required sales to achieve a target net income, I simply add that target net income to the fixed costs and divide that by the contribution margin ratio. Then we introduce the idea of a margin of safety. That is the difference. That is the sales that a company is actually doing now or expect to be doing more than they need to break even. So sales could fall that far and they would still be profitable. Now the margin of safety ratio, once I determine the margin of safety, is to divide that into sales, and I get a percentage like 33%. And lastly, the break even for a multi-product company. We use our understanding of costs and how they behave. And we develop the weighted average contribution margin, and we divide that into the fixed cost. And lastly, of course, if we have a constraint, we want to maximize the total contribution per the constraint, or the limited resources. So that concludes then the third module on cost and cost behavior and the development of the cost, volume, profit. We have many exercises and problems, interactive exercises and problems that go along with this module.